I believe that retail REITs and also industrial REITs, they often show greater resilience. So if I look at industrial REITs, right now they have evolved beyond just the traditional warehouse facilities. They have also pivoted into the more specialized new economy assets, like they have business parks, they have more modernized logistics spaces. Then when we are looking at retail REITs, particularly those with a portfolio of suburban malls, they also tend to demonstrate higher resilience. Pockets of opportunities back then within the tech sector. For example, if you look at companies like Adobe, Accenture, right? These are some of which we also shared with our subscribers as well. So recently, we also witnessed the rebound of the share prices for these stocks. So instead of going big into just the tech companies or only the AI related companies, what we did was we chose to be invested in other sectors as well that have yet to partake in the rally meaningfully. So this would include companies that belong to, say, the consumer defensive, the consumer cyclical sectors like McDonald's. So for example, if you talk about McDonald's, it has shown very consistent growth in terms of its top line. So in that instance, we were lucky to have exited earlier and averted an even bigger crash, right? But had we been late to this, my opinion is that the right decision is still for us to cut losses. Right, to quote Warren Buffett, right, he has said something before that it is important when it comes to investing, right? It must be something that you're looking at an important thing and it is also knowable.
Hey everyone, welcome back to the channel. Today we are hanging out with my friend Hazel. You might know her as the financial coach from The Joyful Investors and her many posts on Investing Note. But before we dive in, if you're new here and enjoying this kind of podcast episodes, remember to subscribe and ring the bell to be notified in future. So without further ado, let's give a warm welcome to Hazel. Hi Hazel, nice to see you today.
Hi, James. Hi, everyone. I'm Hazel from the Joyful Investors. And thank you, James, for inviting me on your YouTube channel today.
Yeah, thank you. Thank you. All right, so to start off, right, I understand that you came from one of the big four accounting firms and then to set up the Joyful Investors with a few partners. Could you share with us the reasoning behind and what is your aim at the Joyful Investors?
Yeah, so prior to embarking on the Joyful Investors, I actually pursued a career in the financial field in one of the big four accounting firms, from which I was really grateful that I gained many learning opportunities, which include exposure to analyzing the financials of businesses. I also got to speak to key finance personnel, and all of this definitely it widened my perspectives and my knowledge on how things actually work. But also at the same time, during my time there, I also found myself being caught up in the relentless cycle of the rat race. Where, for example, I was really sacrificing a lot of my personal time, like working till 2 a.m., 3 a.m. the next morning. That was something that's nothing out of the ordinary. And in fact, I could already be considered as one of the more lucky ones because I have colleagues, right, who maybe they work till like 5 a.m., 6 a.m. the next morning. So one of the very interesting sight that you could observe at that time was that oftentimes you will hear your colleagues comparing with one another who held the best record for working later hours. And I felt that that was not exactly a healthy lifestyle and definitely not the kind of success that I envisioned myself to be in. Unfortunately, it was also around that period in time where I experienced the inevitable part of life, where my father he got into a very serious accident and he went into a vegetative state. But because of the nature of my job, it did not really allow me to spend much time to take care of him. So eventually, what I did was I took unpaid leave for a couple of months to help out with the family matters, and I also took that as an opportunity for me to reflect on the purpose of life and what I really want to achieve. And it dawned on me that all this while, what I've been doing is I've been simply pursuing what the society deems as successful, what the society deems as the right and correct path. So I wasn't really pursuing what I really want to do. Neither did I truly find meaning in what I was doing. And in this process, of course, I sacrificed a lot of time that I could have spent with my loved ones. So as I was planning for my next stage of life, the idea of promoting financial education among investors, it popped up. at that time, I was already investing in the markets, and I also knew the importance of it, how it is important that we invest early so that we can beat inflation and to let the money work for me, right? So I started the Joyful Investors along with my sister Kathy, and also with Coach Keith, who joined us. What we wanted to achieve is the goal of helping more investors who may be struggling in this journey, because understandably, when you talk about investing, right, it's usually associated with a lot of complexity, a lot of stress and all that. So, and I noticed that that is also the same for my peers who have financial background. Like, for them starting out investing, right, it's also not exactly an easy process, even though they have some finance background. And the reason to explain this is because usually a lot of things that we learn on finance textbooks in theories, they may not work out exactly in the actual financial markets. So there is this, I would say, a missing knowledge gap on how the actual stock market works and how and what we learn on the textbook. Um, Similarly, if you look at investors who have been in the markets for some time, uh, some of them they can't produce the kind of results that they aspire to. And upon hearing their stories, we also realize that a lot of times it is because of a lack of proper investing framework, where many of them are they are simply following mainstream advice, or they may be just investing based on what's popular right now, what's the trending stock right now, right? What everyone else is buying right now. Yeah, so that's why we started actively to create content, be it in the form of videos, articles, so that we can share some of the investing principles that we believe in ourselves. And we hope that we can also help investors to make sense of the latest market events through bite-sized insights that we share on our various social media platform. So that eventually, as our brand name suggests, right, we hope that investing can also be a joyful endeavor for many investors as well. Yeah.
Thank you, thank you. So it's to spread the joy lah, through
Yeah.
investing.
Yeah. So that this
Yeah.
process doesn't have to be, a very stressful process for
Mm.
investors.
Yeah,
Hmm.
nice. Well, I didn't realize it was so bad for the audit side of things. I thought that mine,
Yeah.
because I'm also coming from
Ah.
hedge fund accounting, so I do
Mm.
also do OT most of the time, but it's only
Mm.
until like maybe 9, 10 p.m. But yours is like,
Ah.
wow, your
The
midnight.
next morning already.
It's kind of crazy. But I mean, how do you have a
Yeah.
family life with that
Sorry?
kind of, how do you have a
Oh, family
family
life.
life?
Ah.
Yeah, to have that
Yeah.
kind of
Right.
yeah, very tedious working schedule.
Correct, correct, correct. And
Yeah,
sometimes when
yeah,
you are in it, you are just like sunk in it. You don't really realize, something is
yeah.
wrong
You
because
just
everyone else around you are doing the same thing. Ma.
yeah. It's really a rat race, really.
Mm,
Okay, thank you. Okay, so just now you mentioned about framework, right? So I would like to
mm,
jump back to investing note because I realize you have a lot of content surrounding REITs
ah,
and you've conducted many REIT investing workshops before. So can you share
mm.
briefly what you teach inside, like the framework and the things to look out for?
So, in our investing process, when we're dealing with REITs, yes, definitely there's a structured framework that we use it ourselves and we also teach to our students. So, firstly, what we want to achieve is we want to focus on the important and the knowable stuff. Right, to quote Warren Buffett, right, he has said something before that it is important when it comes to investing. Right, it must be something that you're looking at an important thing and it is also knowable. So by knowable, what I mean is to study the financials of the REIT so that we can assess their fundamentals. We can look at their track record, the track performance over the years. So these are the numbers, the statistics that are actually publicly available for investors to examine and to analyze. Then once you have taken this first step, the next step is to then stay disciplined regarding the appropriate price that you want to pay for this high quality REITs. So how we do so is we actually apply technical analysis methods that we personally employ ourselves and we find them useful in this journey. The reason for doing so is that because if you look at the stock charts for REITs, we realize that the share price, right, can tend to be more cyclical in nature for share price of REITs that are listed in Singapore. And therefore, capital appreciation, capital losses, they come into the picture as well for REIT investments. So we want to avoid a situation where we are buying the REIT, at the top of the cycle, but instead we prefer to buy at, say, certain support levels. Yeah, so that's the overall framework. Perhaps to illustrate this thought process further, a recent example is that we made the call to add on more aggressively to our existing REIT positions just sometime last month in June. So this was done, of course, based on firstly, we have conviction in the resilient REITs that we have identified based on their fundamentals. Then secondly, when we look at the stock charts, right, we have identified possible turnaround price regions that can give us a good risk to reward setup. But of course, by doing so, it is by no means to say that we can predict what's going to happen next, right? Or we can predict that the recovery of the REITs market is going to happen immediately. But why we do so is because we believe that if we diligently build up these positions in the for our REITs portfolio, then we are positioning the overall portfolio in a more, I would say, in a more risk prudent manner. And the good thing is that, while we are doing this for REITs, but it's not just a framework that we only apply for REITs. In fact, we apply it to other stock markets, say US stock markets as well. Because I believe that if we can pay attention to firstly what we invest in, then secondly the price that we invest it at, that can give us some extra edge in the financial markets, where we try to act more prudently based on the current market opportunities, and in a way where the odds are more stacked in our favor, tilted more in our favor. Then over the long term, that will increase our long-term success in the financial markets. Yeah.
Okay, thank you. So you mentioned about the US stocks, right? So we will cover that later on. But first, right,
Okay, sure.
when we talk about REITs, so the thoughts
Mm,
on interest rates will come out. So we definitely can't miss that. So what are your thoughts on whether, the interest rates will drop right now,
ah.
or, things like that, and whether you will push up the REITs prices? Yeah.
So on interest rates, I do believe that the interest rates would eventually come down. Although maybe we may not return to like the very low level of interest rates, like 1% that we had during the pandemic period, right? In the near future. But there are a couple of reasons why I believe interest rates would come down. So firstly, if you look at history, right, if that can serve as a useful reference for us, we have seen how in the past decades, investors, they have been through multiple crises in the world, right? And that have resulted in the Fed either raising rates or they cut the rates in order to resolve those crises at that time. So as the conditions of the economy shift, as it changes, then the central bank, they will intervene accordingly, whether to raise rates or to cut rates. Previously, I've also compiled a graphical representation of how the Fed has raised rates, they have cut rates on many occasions since the 1990s. Yeah, so that is one reason. Another reason is because if you take a look at the probability of a rate cut coming up next, right, using the CME Fed Watch tool, we can see that right now the probability of a 25 basis point rate cut that is happening sometime in September, right? It is as high as nearly 100% really at the moment, based on the data that I last saw yesterday. And potentially there might even be another 25 basis point cut in November, although the probability right now is just about 60% at the moment. But all of this goes to show that we are possibly at the peak of the rate hike cycle. Yeah, and if you also look at inflation data, which is, yes, it's a lagging data, but if you just take a look at the overall trend, you can see it's a very steady downtrend for the US core CPI since the start of 2023. So with interest rates coming down, this would then make the REITs look more attractive to investors again. And the fundamental reason is because REITs is a sector, as we all know, is very sensitive to interest rates, because REITs, they have to depend heavily on the loans to fund for their property acquisitions. So with lower interest rates, that would lower the financing costs for REITs, and that can have a positive impact on the DPU for unit holders. So something which unit holders would actually like to see, right? Another perspective is that with lower interest rates, that can give more room for the REITs to go and pursue new acquisitions. Because right now, what we see in this current high interest rate environment is that many of the REITs, they have been more prudent in terms of their capital management. So they have been less active in pursuing new acquisitions to make sure that all their debt metrics, right, all these are within a reasonable range and within the regulatory limit. So with lower interest rates, maybe that would actually help to provide more room for REITs to pursue new acquisitions. And that would then, in turn, it may have impact on the DPU as well for unit holders. Yeah, so that's my view on interest rates.
Yeah, definitely. So there will be more activity going on because the past year we have been like hearing not much activity going on as compared
Yeah.
to when interest rates are all time low, right?
Yeah.
Yeah. So
Yeah.
okay,
In the past, it's
then
just about interest rates.
yeah, lor, yeah, lor, yeah. So okay, so we cannot miss out picking your brains on your favorite REITs and sectors also. So can you share one or two of them which you like at this point in time? Yeah.
Uh, okay, so maybe I will just talk more in terms of the sectors lah, of the REITs. So
Okay.
when we're looking at sectors within the REITs, perhaps not only just in the current climate, but also over the long term, I
Mm,
believe that retail REITs and also industrial REITs, they often show greater resilience. So if you're looking at industrial REITs, right now they have evolved beyond just the traditional warehouse facilities. They have also pivoted into the more specialized new economy assets, like they have business parks, they have
mm,
more modernized logistics spaces. Then, when we are
mm,
looking at retail REITs, particularly those with a portfolio of suburban malls, they also tend to demonstrate higher resilience. So, in the last
mm,
couple of years, we know that there has been a lot of talks about e-commerce and how the rise of e-commerce may actually cause the retail REITs to turn obsolete. But what we have also observed in the last couple of years is that many of these REITs are still doing well. In fact, you look at all the suburban malls near our residential areas, they continue to attract very good shopper traffic flow. So people are visiting the malls for their necessities. Sometimes they just visit the malls to have a walk and to spend some time there. And in fact, certain businesses you see that in terms of the business model, they also do not just want to restrict themselves to to online channels, but they would like to have a mix of like offline and online mediums. So that would also be good for the retail REITs. Certain categories of products, people tend to purchase them more in person lah, because you want to see it first, you want to feel it before you would like to purchase it, right? And of course,
mm,
not to say services. If it's about services, generally they still have to be delivered in person, right? So this is why I believe that retail REITs, they are still here to stay. Yeah. So these are some of the sectors within REITs that I believe generally they'll be more resilient. But of course, if you're talking about in terms of the supply of properties within the respective sectors, definitely the pipeline of new supply, they may have certain impact on the occupancy rates moving forward. So this is why it is important that we do a proper and holistic assessment of the individual REITs to look at their overall performance and resilience. Maybe not just only in terms of supply, how the demand has been so far, so that overall we can see how the different forces, the different parts have an impact on the performance of the REIT moving forward. So I believe maybe what would be helpful over the long term would also be the thought process lah. Again, how do we look out for the what REITs do you want to buy?
mm,
And when we set an investment thesis, this thesis, like it should be able to stand the test of time. Something where 5 years down the road, or 10 years down the road, you believe that this business is likely going to stay, is likely going to be still relevant. Yeah, so that is something
mm,
important. And on top of that, maybe instead of just asking ourselves, what are the 5 reasons I want to invest in this REIT? We can also ask ourselves, what are 2, 3 reasons why I want to stay away from another particular REIT? So that way, that will help to steer away from many of the problems or the troubles that we may face in this investing process. Yeah.
that's cool. That's cool. You remind me of the Charlie Munger's quote, "Reverse
Mm.
engineer."
Reverse engineer.
Yeah. Okay, so now let's switch over to stocks instead, right? So
Okay.
in general, I noticed from your blog that you have been
Mm.
managing a Moneyball portfolio and also listed the core principles of your methodology. Can you share more
Mm.
about this? Yeah.
Mm. So, to break down and explain the intricacy of the Moneyball investing methodology, perhaps I have to start off from the term Moneyball first. So,
Okay.
this word Moneyball is actually not our own invention, but we took reference from a movie. There's also a book called Moneyball, which was actually filmed based on a true story. So, it's a true story of how the baseball manager, Billy Bean, he managed to transform a low budget baseball team into a winning team. So we found that there are some very strong parallels and lessons that we can also draw from this baseball story. Because as we all probably know, when it comes to sports, right? If a manager wants to recruit a very popular player, usually it's very expensive. right? But unfortunately, for the case for this baseball manager, Billy Bean, he did not have the luxury of a lot of funds. Instead, he had very limited funds that he's given with. So instead of going by that usual mainstream route, which is to go and recruit all the popular star players onto your team, right? What he did was he made use of statistics as well as probabilities. So he went on to recruit players that are currently unloved, and therefore they're cheaper, right? But what's interesting is that these players, he assessed them and he realized that they still have a very good probability, potential of doing well in their respective roles on the field. And that's how eventually he actually brought success to the overall baseball team. So in the same vein, we find that there are some lessons that we can draw from this true story. Because when we talk about investing, many of us, we have limited capital, right, to invest in the markets because we are limited by what we earn from our salary. Many of us, we do not enjoy the luxury of being born in a well-to-do family. Yeah, so the Moneyball investing methodology, what it aims to do is we want to make more efficient use of our limited capital. We want to deploy them to invest in the high quality companies. But right now, if you look at the stock charts, they are temporarily unloved by the crowd. Yeah. So essentially, first step is we want to apply fundamental analysis. We want to identify the sound stocks. Then second step, we will use technical analysis. We want to buy them at favorable risk to reward setup based on the probabilities. Then over time, what we will also do is we'll shift our capital around the different stock counters based on the current market opportunities and also based on concepts like sector rotation. So at times you'll find that maybe we might increase our bets, we might be more aggressive because we find that the odds are more in our favor. Then at certain times we might take some profits off the table because we feel that the odds are more stacked against us. And to make such decisions, usually what we do is look at the stock charts. So we apply the TA to understand the current market sentiments, whether right now it's better to stay defensive, to focus more on the risk of losing money, or to stay more on the aggressive side to focus on the risk of missing out on good investment opportunities. And of course, all of this must be built upon that, the stocks we are looking at, they are fundamentally good companies. Yeah. So pretty much it's like how a manager manages a sports team. Like let's say, in football, the manager has to make a decision on who's going to play, who's not going to play for this match. And usually it's based on the current situation of the match as well. Whether right now you think you want to be more defensive or you want to be more striking a balanced approach or you want to be all out attack. Yeah. But of course, understandably for such an approach, right, in the short term, there could be periods where there is a drag on our portfolio performance because we are still anticipating for the rebound of the stocks that we have invested in. But over the long term, we believe that we should be duly rewarded when the fundamentals of the stock lead this stock price rally. Yeah. So what's important maybe is not just only in terms of the selection of the stocks, but also to understand that when you have different stocks, different players in your entire portfolio, then the whole can be greater than the sum of its parts. So what we want to do is to build up a portfolio whereby we try and reduce the downside volatility and at the same time to gain some excess returns. Yeah, so that's the methodology, what Moneyball investing is about. And in fact, it is also the same methodology that we adopt for the investing note portfolio that we also launched earlier this year as well.
That's cool. That's cool. So I have one more movie to watch later on. Moneyball. I haven't watched that before. Yeah. Sounds
Yeah, you
quite
can try and watch
interesting.
it.
Yeah. Okay, so my follow-up question will be on the US stock picks. So are
Yeah.
there any US stocks that you have high conviction in? And what makes you confident, right, in them and their future performance? Are you able to share
Okay.
some?
Regards to high conviction stocks, there'll be along the investment ideas that we have presented in the investing note portfolio in the past couple of months. So we believe that actually a sector rotation is due. So instead of going big into just the tech companies or only the AI related companies, what we did was we chose to be invested in other sectors as well that have yet to partake in the rally meaningfully. So this would include companies that belong to, say, the consumer defensive, the consumer cyclical sectors like McDonald's. So for example, you talk about McDonald's, it has shown very consistent growth in terms of its top line, in terms of its bottom line as well over the last couple of years. And the interesting about McDonald's is that while many consumers, maybe we know McDonald's as a fast food company, right, that makes money from burgers, from their fries, but actually a very significant portion of their revenue, it comes from the rental income, the rental revenue that they receive from their franchisees. About 40%, about 40% of that. So what that means is that there is a lot of stability for the company's revenue. Yeah. And over the years, the company has also built up a very strong brand equity as well. So these are some investment ideas that we have actually embarked on in the last few months. But that said, with this current tech rally, right, there are also some opportunities, pockets of opportunities back then within the tech sector. For example, if you look at companies like Adobe, Accenture, right? These are some of which we also shared with our subscribers as well. So recently, we also witnessed the rebound of the share prices for these stocks. So if I could sum up, these investment ideas generally they are picked again based on that two aspects, that firstly the company must be a high quality company. Then secondly, in terms of the stock chart, right, there's a favorable risk to reward setup so that we can actually buy them at a good price on the stock charts.
Thank you for sharing. Yeah. Okay, interesting you talk about McDonald's because actually I am looking at McDonald's myself as well because it's
Oh,
come down
okay.
quite a bit. Yeah.
Yeah. So
And
what are your views on this?
my views are because
Uh,
my family and I we eat McDonald's practically once every week, at least at once.
oh,
Yeah,
okay,
it's
okay.
either me or my kids or
Uh,
together. Yeah. So it's always been there. It's just that I'm waiting for the right moment to go in. Like what you shared lah,
mm,
about the
mm,
stock chart thing. Yeah, because we already
mm.
know that it's steadily going up year after year, kind of.
Yes, the performance has been very consistent.
Yeah, very consistent. Okay, so thank you for sharing. Yeah. So the next one that I want to check with you is actually when your investment thesis fails, right? So what will
Mm.
happen? Like, can you discuss a stock pick that didn't go well as expected? So what did you learn from it? Yeah.
Mm. Offhand, I can think of one which is the Manulife US REIT, which was back sometime in 2021. So that's a few years ago. So back then, because we had COVID, right? So we actually evaluated that the pandemic may have resulted in some structural changes in
Mm,
which people in the United States, they now prefer to work from home. So this work
mm,
from home trends have actually disrupted the renting of the office spaces. So some of the
mm,
tenants they could be downsizing their footprints, and so for office heavy REIT like Manulife US REIT, it could potentially run into increased risk of vacancies going forward. Um,
mm,
Together, if you look at the stock chart, right, there is this poorer performance on the technical charts during that period. So
mm,
we finally took the decision to divest totally away from it, and that was sometime
mm,
in middle of the year in 2021. Before we also experienced a very huge crash that continued after that. Yeah. So in that
mm,
instance, we were lucky to have exited earlier and
mm,
averted an even bigger crash, right? But had we been late to this, my opinion is that the right decision is still for us to cut losses and then
mm,
deploy that remaining capital that we have elsewhere into other REITs. Because firstly, the investment thesis for the company is less sound as compared to before. And
mm,
secondly, there are still many other good REITs that we can actually explore in the market. So this increased risk, we thought that it wasn't necessary for us to take on. Yeah, and this
mm,
was in fact against a lot of news reports, analysis that was still very bullish of Manulife US REIT back then, where they
mm.
were talking about how things are going to be improving because the negatives have already been largely priced in. So
Yeah,
looking at headline news like this, sometimes it may induce us to continue to buy the dip lah. Yeah,
yeah,
but
yeah,
of course. Yeah, but of course, it's not to say that we always get it right when we form our investment thesis.
right.
Just like it's also not necessary for all the analysts to get it right all the time for them. But I believe what's important is that we can form our own judgment so that we can be more
Mm,
self-directed, more independent
mm,
investor. So that one
yeah.
day, once we invest in this stock, right, if anything changes, if need be, we are the ones who can tell ourselves to exit the investment without having anyone else to tell us that we have to do so. Yeah, so that's
Mm.
something that I can share. Yeah.
Yeah, I also concur with you. Yeah, back then I still
Mm.
can recall the Manulife go down, and then the
Yeah.
analysts keep reducing the target prices, but generally they are still bullish on it. So I was like,
Mm.
what's going on? Is there something that they are hiding or things like that? Yeah, I mean, you bring back my memories lah on that. Yeah, okay. So right, for the next question I have, asset allocation. So do you have any other than putting your portfolio into equities, right, or REITs,
Mm.
do you have other uh asset classes that you are looking at for your entire portfolio?
In general, we are more focused on the equities and also
Mm,
REITs lah. So in general, I would say majority of the funds are put in there. Of course, sometimes when we are waiting for opportunities in the market, some of the money may be put in the money market funds, so that it
mm,
is actually still liquid. And then when need be, we would actually take out the money and then put into the equities. But I would say largely for us, the stock markets, equities is actually a very big part. So what we do is we will shift the funds around, whether in the US stock market or whether in the REITs. So it all depends on the market opportunities. So like for example, right now, in the current situation for REITs, it is actually very beaten down, and we think that there are a lot of opportunities for upside potential. So in
mm,
that sense, we have actually shifted quite a big portion of the funds into REITs lah. Yeah, although
mm,
we will say that generally we are still looking at more of capital appreciation, but it is also
mm,
good that we can actually build a portfolio that eventually provides us with all the dividend income. Yeah, so
mm.
this is how we have actually been managing our portfolio.
Cool, cool. So you actually have like a US stocks which are more higher risk, and then the REITs which are considered lower risk. So you just shift accordingly, lah. Right.
Yeah, so it really depends on the market opportunities. Like when the US stock market is really going up, there isn't much, opportunities. But if let's say in REITs, you see that there are more opportunities, not just only in terms of the dividend income, but because of the share price has been really beaten down, right? So
Written
there are
down.
also share price recovery potential. Then that
Mm-hmm.
is where we can also shift more of the funds into the REITs as well. Then eventually, as the REITs recover, then we will think about, based on the current situation, what are the opportunities again. Then we will shift it accordingly. So in a way,
Mm-hmm.
that's like the Moneyball methodology, lah, where
Mm-hmm.
we don't restrict ourselves to really a specific, like, how a certain ratio where you have to stick to, where how much of your funds must be put in this market versus another market and so on. But rather we shift based on the opportunities, because the
Mm.
opportunities, they come and go, right? Sometimes you can't predict what is going to happen. Like, nobody can predict that, we're going to have inflation, we're going to have war, things like that. But when it comes, then we will act accordingly, lah, based on the opportunities.
Nicely spoken. Yeah, yeah, yeah. Thanks. Yeah. Okay. So we have two more questions, right? More relaxed one. So the next one is investing tools. So what are some of your go-to tools, yeah, for staying up to date on either market news or company analysis?
Mm. So in terms of company analysis for financials, right?
Mm,
Generally we leverage both the free platforms like Yahoo Finance, as well as some of
mm,
the paid platforms like say Morningstar. So,
mm,
and of course not to forget all the annual reports lah, that they are
mm,
publicly available for investors to read. So all of
mm,
these can help us to have a more in-depth analysis for ourselves, whether for ourselves, for our students, or for our subscribers. Then when it
mm,
comes to the stock charts, right? For the technical analysis portion, we will use softwares like TradingView, the Think or Swim charting software. So these are some of the softwares that we have been very comfortable with, because they have very good interface features and tools as well. So these are generally the different tools that we need for us to have the fundamental analysis going, as well as the technical analysis.
Okay. Thank you. Okay. So last question I have. What advice would you give to the audience or your younger self, assuming that you are just starting out in
Mm.
investing?
Okay, maybe I can share two pieces of advice to
Mm,
the younger community who are looking to get started in investing, or you've already just started but generally still new. The first point would be to start small in the early stage, and you try to understand yourself better as an investor. So in
mm,
the early stage, it is actually good that we start small, say, like 10K, 20K. The rationale is because you can actually learn just as much when you are investing with a small pool of funds as much as when you are investing with a big pool of funds. So the important thing is we also want at the initial phase we want to preserve our capital because this
Mm,
learning is going to be a long game. It's going to be a long process. And when we are a learner, sometimes we could be more lucky. Sometimes we
mm,
could be unlucky. Right? Even if you're
mm,
lucky now, maybe in the future you could become more unlucky, right? So we don't want a case where we lose all of our money while we are learning before we have obtained the necessary skills. So in fact, we
mm,
have speak to investors, we have met people who have they start off with a very decent amount of funds, but along the way as they learn, they lost a lot of the money, and by the time that they really master the skills, they are just left with say 1/10 of the money that they started with. So it's going to be very difficult. It's going to take time for them to recover from that. Yeah.
mm,
And on top of that, in this process, other than understanding the companies that you want to invest in, right? I think it's very important that we also understand ourselves as an investor.
mm,
Do we have the
mm,
kind of emotional fortitude or the technical competency where we are able to take our portfolio further? So it's
mm,
important because there's this saying that people say if you don't understand who you are yourself, right, then the stock markets is a very expensive place for you to find that out. Yeah. So we don't want that to actually happen. So the most
yeah.
important task for a beginner would be how can I double my money in a sustainable manner? So it doesn't matter that I'm just doing it from 10K to say 20K. But what matters is that I acquire the skills so that eventually I can move from 20K to even further beyond. And once you acquire the skills, you will then be, unstoppable in your investing journey already. Yeah. So that's the
Wow.
first one that I would like to share. The second one is to keep an open mind, focus on what really matters by looking at the broad picture in the stock markets. Like for example, there's this very common argument that we often hear. People like to argue and discuss, is dividend investing better or is growth investing better? Then each camp they will cite their own reasons for that. Yeah. So after
Yeah.
we speak to many investors, we some of the common reasons that we hear are, for example, when it comes to the US markets, right? Some of them will avoid US markets because they think that they are uncomfortable with the 30% withholding tax. Then on the other
Mm,
hand, some people will avoid REITs because they are concerned about issues like share dilution because you have rights issues, right? And
mm,
other reasons. But
mm,
what I would like to share is that I think it's important that we focus on what truly matters by looking at the broad picture. And of course, your current stage of life. Yes, that is also relevant. So, for example, if you're looking at investing in the US stocks, usually the main motive is we want to get capital appreciation, right? So,
mm,
if that is the case, then dividend income, you can see it as like some extra bonus. Lah. So the
mm,
withholding tax shouldn't be so material until you want to abandon the US markets altogether for the capital appreciation. Then at the same
mm,
time, if you're looking at REITs investing, for example, for dividend income,
mm,
I believe what's most important is whether we can make money overall out of our investments. Sometimes you
mm,
can don't subscribe to any rights issue, but it can still be profitable because you're investing in a good REIT and you're buying it at a good price. Sometimes it can still
mm,
be unprofitable even if you subscribe to every other rights issues and so on. So in other words, there's nothing really very good or bad about dividend investing or about growth investing because all of these are just a means to an end. Yeah. So
mm,
theoretical knowledge, factual knowledge, they are very important, but you also have to see whether it applies in the real world context. It's important that we keep an open mind. Don't just miss the forest for the trees, right? Sometimes, because of our own personal experiences in investing, it can be easy that we may become more myopic. But I believe
mm,
that true knowledge is about understanding, what it is, what works, what don't works, right? When does it work? When does it not work? Then we can make the switch, the necessary switch, based on the situation. Yeah.
Very nicely spoken. Don't miss the forest for the trees. I also agree on that. So every time when they get
Mm,
started investing, they always look at the tree. They miss the entire
mm,
crop picture. They always just ask me, "Hey, this
mm.
stock good or not? Can buy or not?" That kind of thing. Like this is a
Yeah.
very very narrow focus as compared to what you shared.
Yeah.
Yeah,
Yes,
they
I
miss
totally
out the
agree.
crop picture. Yeah,
Actually, the understanding the framework I think is more important, like how I can do it, so that eventually I don't always have to ask someone for stock tips, right? But I can actually do it myself. I know when to buy. I know when I need to sell when time comes. Yeah.
yeah. It's about knowing yourself, lah, like what you shared.
Mm,
Okay, thank you very much. Okay, so that's all the time we have for today's podcast. Huge thank you to our amazing guest Hazel for sharing all these wonderful insights with us. So we greatly appreciate you being here. Thank you so much.
Thank you, James, for inviting me onto your YouTube channel. It was really great chatting with you today.
Yeah, thanks. I learned a lot from you as well. The Moneyball, especially. Going to watch later on.
Yeah, you can check out the movie.
Yeah, thank you. All right, so everyone, if you enjoy this conversation and want to see more podcasts like this, make sure to hit the subscribe button and ring the bell. Okay, so once again, thank you for watching, and I will see you in the next episode. Thank you, Hazel.
Thank you.
Bye
Bye
bye.
bye.
Bye.